What's up, y'all? Tim Bratz here with Spilling the Beans. Today I'm sitting down with my boy Chris Lamb. Chris has actually been on Spilling the Beans probably a year and a half, 2 years ago maybe, and was talking about his credit business back then. He was helping businesses get business lines of credit and gain access to capital, and that has parlayed into him being able to then get into a bunch of real estate deals and fund and be the funding arm for a bunch of developers and builders on the new construction side. So he's gone through a lot of learning curves on that side of things, but he bought right. He stuck to good fundamentals in that side of his business, and I'm excited to learn what he's learned, right, over the course of the past year or 2 years as he's gone down that path, and how he's going to continue developing that business over the course of the next couple of years. So let's go sit down with Chris Lamb and learn all about the development side of new construction. Chris Lamb, what's up, buddy?
Hey, bud.
Welcome back.
Good to see you.
Spilling the Beans. So, dude, I know you're working on a lot of different things and have had a big, shift, I guess, pivot in your business over the course of since the last time that you were here
Sure.
on Spill the Beans.
Yeah.
So, dude, I want to talk about all that stuff. I know the credit and financing world has kind of changed, and some of your attention on that has changed. Some of your opportunities over there have changed. There's obviously a lot of obstacles that we could talk about, but more importantly, I want to talk about a lot of the new construction stuff that you're doing.
Yeah.
The development side of things, and I think that's one of those can be a shiny object for a lot of people that they get excited about. The product, because it's a great product. It's new. It's easy. There's a lot of amazing benefits. I just think people don't have proper expectations a lot of times getting into that side.
Yep.
And so I want to hit on some of that and some of the things that you've learned while you're doing that, how you find these deals, how are you funding these deals today, and then what's kind of like the exit strategy on a lot of those things. So before we get into that, let's talk just real quick. I don't want to spend too much time on it, but let's give a quick update on the credit markets, right? Obviously, interest rates have gone up like crazy.
Absolutely.
A lot of the banks, since the last time you were here, SVB went out of business, and Signature Bank went out of business, and there was a lot of scares on that front at the beginning part of 2023. And now we're looking at, I had a line of credit that I had with one bank, and after 12 months, they're just like, hey, we're just not doing these anymore.
We're done with it. Yeah.
Right? And so we're like, oh man, so all right, well, I don't have the liquidity that I thought that I had. And I assume there's either a lot of risk in that, or they're just losing money as interest rates kept on rising. So what did you see on that front?
Yeah, so it's always unfortunate when the bank says, hey, we're no longer going to give you the line of credit. That's why I'm always preaching, get as much as you can safely. Because if you lose 10% of your available credit, but you still have all of these other weapons you can use, you can kind of sustain that. Whereas if you just have one line of credit and the bank, and they've done it to me. Last year they called a local bank, 100,000. Hey, we're not going to renew it. Just close it overnight. And to this day, I still have not gotten an explanation. I kind of have a suspicion why, but it happens. And so backing up a step, Americans are getting in more and more debt. We're north of $1 trillion in credit card debt alone, just like personal unsecured debt. Surprisingly,
and that's gone haywire, because the stats that I saw were like people were saving more and had less debt than ever before in like 2020 when COVID hit. Probably some scares, and then the market just got this infusion of just got an injection and steroids on all the fiscal money that was pumped into the system, and then it went crazy and people got spend heavy.
And then inflation and the cost of goods, everything going up, you've got to make up for that. So what are you going to do? You're going to go to your credit card. Like I've been guilty of it. It's a tool, it's a comfort thing, but it also can get you in a lot of trouble. But surprisingly, the average FICO has increased. And that kind of shocked me. So it went up to about a 718 for the average American for their credit score. And so that's telling me that folks
That's pretty good.
It is. That's telling me that folks are paying their bills on time. They're taking out the debt, but at least they're making that minimum payment. So if you can do that, at least you keep that good monthly, payment history in check versus missing it, and then really your score tanks. So obviously you got the debt's increasing, credit score is still good, but the biggest difference I'm seeing with banks now versus last year is they're really selective in who they do business with. Interest rates have gone up. They're asking for tax returns. they want to kind of see who are we getting in bed with, in this partnership. Whereas a year or two ago, you could kind of skate under that, stated income platform. That's kind of gone away. It's not to say you can't still go out there and get it, but you just got to show a little bit more on paper. And so there's still a lot of banks. They're still lending. I mean,
what kind of rates are you seeing out there?
Yeah,
on the lines?
Lines I've seen anywhere from, I'd say 8 to 14. I'm actually going through an SBA micro loan right now, and the interest rate is prime plus 3, so it's 11.5 today. That's pretty good for a loan basically over a 10-year period. So I'm kind of working that one, but they haven't gone up super high. I mean, they used to be 4 and 5, 6, 7%. Listen, that's the wild, wild west. Those days are over, So now it's like, okay, if I'm 10 to 12, 14, what asset or vehicle am I putting it in that's going to make me money?
Yeah.
So really, you just got to adjust. But
yeah, and people get so obsessed over the rate.
Yeah.
It's like, all right, go find a better deal.
Yep.
All right, this is just it's a line item in the deal, right? Like, the roof is going to cost this much, and the flooring, the paint, and the fixtures, and are going to cost all these things. Well, your capital is going to cost this much, right?
Sure.
And that's where HGTV doesn't show you, right? They show you what the purchase price and the hard costs are, but there's the carrying cost, and that needs to be calculated into any deal that you do whenever you're borrowing money against it to understand what your true cost of the deal is, right? And what you're going to end up with at the end of the day. And I think an interesting piece is like, these lines are getting called by people who make their payments every single month.
Absolutely.
And who have 800 credit scores
Yep.
and have great income. And so it's the limitation for me of going to banks has always been stuff like that.
Yeah.
I did everything right.
Yep.
And you still have the right to pull my line of credit
Yep.
and create this huge hurdle, potentially, in my business that was out of left field, man, and I wasn't expecting. And dude, that's why I've always gone to just private money.
Yeah.
And especially if lines of credit are at 10, 12% now, average, dude, go and find somebody whose stock market funds have gone down by 10, 15% over the past few months, and say, hey, without risk of principal, you lend to me and I'll pay you 10% fixed rate of return.
Yep.
And now you don't have to worry about somebody calling the loan due.
Yeah.
Right? And it's not a sale. It's not like I have to go out and hunt private money. It's educating people that there's something better out there than what they're currently invested in.
Yeah.
And right now they're in something that loses their principal balance. Not only does it not pay dividends, but it's losing principal balance on their investment. And if they can take that money out of the stock market, or they have a 401k and they put it into a self-directed IRA or self-directed 401k instead, and lend it to you or me at 10% fixed rate of return, without the risk to principal, dude, that's a much better position to be in, you know, for them, and it's better for us.
Yeah, and I think that, the key takeaway is, you don't want to go all in on one strategy. You kind of want to have a hybrid. You want to have your private money pool, guys that are going to borrow or lend to you like they have over the years. You want to have lines of credit because that's quick and easy to get when you have it. Then you want to have, your institutional money when it comes to getting hard money loans or, a construction loan, which we'll talk about. Now I've got my foot in all three of those buckets, and I'm not just dependent on credit or just private money, because that could change too. You could go to some other deal that gives them a better return, or the hard money could dry up or become more expensive. So I think that's important to have each of the three.
Yeah. I think always building all those buckets, because as soon as banks come back, right, or rates come down, and lending opens up, like you want to have that. You want to already have the foothold in, right? You already want to have the relationship built, so that way you don't have to start it when it's time to borrow money, and they're willing to only piecemeal a little bit to you. You've already had that relationship, and if you have a long-term mindset, I think it makes sense to have all those relationships in each one of those different buckets. All right, cool. So appreciate that. Let's pivot and shift gears a little bit and talk more about the new construction stuff. Right? I've done some new builds on townhomes and apartment buildings, and could share my experience, but you're building spec homes, right? As not build to rent though, you're doing build for sale.
Correct.
Correct. I want to hear a little bit about your experience, and we'll kind of ping pong back and forth of what I've experienced and what you're experiencing.
Yeah, I think anybody who wants to start and build a new construction business is crazy. First of all, you think it's going to be this.
But I mean, we're a little bit crazy too.
Yeah,
so.
we are. You kind of have to be. That's the norm.
Yeah.
But a lot of people reach out like, "Hey, I want to get involved. I want to get involved." And I say, "No, you don't. Run. Go in the other direction because you have no idea, what is involved from A to Z, the variables, the macroeconomics, the microeconomics, the money involved. Money's probably the biggest one. You've got to have an endless pot of money, and so."
That's the stressor, man. Like when I was just flipping houses. That's why I don't flip houses, because it was so stressful not having any. I'd buy the property.
Yep.
And then all of a sudden, I'd make these payments while construction's going on. There's no income, right?
Nothing coming in
for 3, 6, 9 months. And then even when construction's done, if I'm selling it, now it's sitting vacant. I have a product there that could be generating money. It's not, because it's sitting on the market.
Yep.
It's waiting to be sold or waiting to be closed on. It's a 60, 90-day closing or whatever. And it's just so stressful absorbing that money. And I wasn't as good of a manager of cash flow then, right, as I've grown. But even today, man, I don't like I have the new construction stuff that you're talking about.
Yeah.
It's so stressful because I've done, I don't know, if not thousands, I've at least done hundreds and hundreds and hundreds of flips, value adds, right? I've done thousands of value add apartments that weren't cash flow positive. And even that process, dude, is horrible. It's so stressful even knowing that. And I've never done a project that has ever been under budget or on time.
Right.
Ever.
Yep.
Well, this one's going to be different. No, it's not.
No, it's
not. So how have you been able to manage that and manage that as you're going through this? Because you're building homes down in Jacksonville?
Yeah, so we're in Northeast Florida, Jacksonville, which is a huge market.
Yeah.
I mean, it's massive. That's why we like it. So a lot of folks are saying, Chris, why aren't you building here? It's like 2 reasons, right? The deals pencil out in Jacks, and there's plenty of opportunity. Like we have more land than we have money to buy. I mean, it's crazy how much land's available in Florida.
Yeah.
And so, but you're right, cash flow is probably the biggest weakness in a new construction business. And if you don't plan properly for that or have those resources to plug in, so we use credit a lot, but that's only going to go so far. We have a lot of private money, but now we've got investor payments. So everybody else is getting paid but us. To your point, you're waiting 9 to 12 months for a payday. Like nobody can live like that. So we're taking a page out of the syndication book. We're trying to implement some type of management fee on a raise if we can to pay ourselves first. There's some other
sort of like acquisition fee.
Acquisition fee.
Yeah.
Yep.
Yeah. And dude, for somebody watching this who's a private money lender, they'd be like, well, I don't know if I like that. Here's why you do want that is because like I didn't take acquisition fees for a very long, until probably 2021.
Yeah.
So there's a decade of my life where I didn't take equity. And guess what? Things got skinny. Things got very
stressed.
Very stressful.
Yeah.
Do you want your operator stressed about money and worried about making money somewhere else? Or do you want them focused on this project?
That's right.
You want them focused on this project. So be okay with giving them some cash, letting them keep the lights on, letting them not be stressed about money in, money out, putting food on the table for their family.
GP's
so
got to
that way
eat.
they can focus on getting the deal done, right? I want the operators focus more. So that's been my biggest stressor in all the joint venture relationships that I've had over the course of the past, 6, 7 years that I've been doing JVs. Is, dude, they take down the deal and then they go and spend their attention somewhere else.
Sure.
I should have had an agreement with them that this was their exclusive attention until the property got stabilized. Because guess what? They jump always before it gets stabilized, and then it trails off. The management's not taking care of it. They're supposed to be boots on the ground, and then the deal falls. And then I have to step in, raise more money, take over operations, make less money because I'm diluting equity, and increasing the cost basis because there has to be more investment in. And dude, it's been really, really ugly because you don't have the person's full time and attention. So it's like that needs to be a priority for somebody who's joint venturing with me or someone I'm lending my money to.
And that's a really good point, because so I have a partner in this who comes from a new construction background. He is a brilliant man when it comes to construction. And guess what? He gave up his brokerage. I gave up one of my other businesses for he and I to go all in on this.
Yep.
Because if you're not all in on new construction, it will chew you up and spit you out.
It absolutely
100%
will.
correct.
Yeah, man. And it's, again, timelines always go over. Budgets always go over. Labor always ends up being more. There's always supply chain. There's always the cities, right? The bureaucracy and the utilities and like dealing with getting approvals in place and permitting. And there's so many things that are variables that are outside of your control, but you have an amazing product at the end, right? And so, like the townhouses that we're building, it has not been an easy process with the subs and the lender draws and all these other things. Take time because the subs don't give us the lien waivers, right? And then we can't start the draw process until we have those lien waivers. And then the draw process has third-party vendors that do inspections,
all delayed,
put reports, and it takes 3 weeks for those. And then the subs don't get paid until a week after that when the lender gets that report. And the subs are like, well, I can't pay my guys. I need to go take this other job. So then they walk off until you pay them up. And then they come back and they start over. And dude, it's like you need liquidity. But even, we've raised millions of dollars in order to keep things moving while these draws have been taking so long. And even then, it's like there's still delays and still eats it up, especially depending on the size of the project.
And I think so we're building about 20 right now. We've got a neighborhood that is 13 homes we're building, backs up to the marsh, really beautiful area. And we've owned it for over a year. Our note was 12 months. We had to go refinance that with the hard money lender. We had to rebook it. Nightmare. Absolute nightmare.
You know what's not fun right now? Is taking a construction loan to another construction loan.
Dude, because they only give you based off of how far you are in construction on that house, which is the timing of the inspector going out. But guess what? I just put a roof on. And then this is where it screwed us over is we don't want to bring any money down on the rebook because we have all of this equity in the house. So they're taking equity and moving it over here. It shortens a draw your next go around, and now you got to come out of pocket. So it's a really, we're still untangling that. But fortunately we have credit, we have money to be able to pump in until that draw comes in. You can't solely depend on a draw coming in. Like in a perfect world, roof is on, invoice is in, you submit the draw, the money comes in, roofer gets paid, you move on to the next. That isn't a perfect world. So what are you gonna do when it's delayed 30 days and like you said, they walk off the job and you've got other jobs across town and now they're not doing those. So it's a trickle effect on all of your products. So you gotta keep your subs happy.
And I think the thing to understand here is first of all, there's been a lot of construction loans that were put out over the past 2-3 years, right? People buying land, people starting new construction projects. And all the underwriting of all of those projects was at a certain interest rate for when those projects were completed to then be refinanced, and certain valuations based on that interest rate. Fast forward 2-3 years, those projects are coming to completion and interest rates are 3 times what they were when they first bought that property, which means the valuation has come down so dramatically that they can't refinance. And so the lending institutions, if there were 30 banks that would give you a construction loan 3 years ago, there's probably 1 to 2 today.
They don't have the appetite for it.
Nobody, because of twofold. One, they don't have the liquidity, right? Because none of these other loans are getting paid off. And 2, they already have all these you can either call them non-performing or matured loans, right? That have not been paid off, and it's seen as more risky. And then the other thing with lending from a bank's perspective is if that contractor, that sub, doesn't get paid, and they put a lien on the property, that mechanics lien actually slips in front of the first mortgage, right? Which is why a lot of these lenders are hesitant to do construction loans in the first place. They're super vigilant on getting all the lien waivers, right, before they ever release any money. And nobody wants to come into a project that's not already done because there's risks out there. They don't know what's floating out there from prior to them potentially lending on this deal. So it's very, very difficult today more than ever to get money on the new construction stuff. So it'll be interesting how that kind of shakes out, because there's still a huge demand, right, for all the for more supply, but anybody who doesn't already have the machine working in just like clockwork sees that as a huge hurdle, right? A huge roadblock for them. So, why? Are you going to keep on doing new construction, right? And why are you doing new construction?
Yeah. Why would anyone want to be in this cash intense?
We talked about a lot of pain in the ass stuff, right?
So we talk a lot about being in the right vehicle. And so when I started flipping and a little bit of wholesaling and buy and hold, that was the right vehicle at that time, years ago. But now we're taking all those best practices, and now we're into something bigger that we're all in on, that we believe in. And I think once you build the machine, meaning you document your processes, you hire out the right team, you filter through all the bad subs, and you get the good subs, the subs that can do framing, trim, doors, and windows. Now they can do 4 line items on your scope of work, focusing on those good relationships. Once you build it, and that machine is turned on and it's operating, it's going to be a lot easier to continue to manage. So,
but dude, the hardest one's always the first one.
It is,
right? That's the learning curve.
We went from 0 to 20 in 12 months. So we took a big chunk out, but I wouldn't have done it any other way. We've learned so much, we've grown, and instead of having a closing every 9 to 12 months, we're going to have a closing every month or every quarter. And so we've got a big Q1, Q2 coming up, carry over from this year, where we're going to crush it. And now I can breathe, I can pay my bills, I can put a year's expenses away. And then, but we also, here's another kind of tricky component to building, is you got to have the next flow of inventory coming in. Because you can't just close these 20 and think you're going to go retire.
And then start over again.
And then start over. It's like
the
lead
process
gen,
is
right?
another 2 years.
Yeah. And so you got to, and we've got a strategy. We can talk about land banking, kind of what that is and how that looks. But you eventually want to have iterations of dirt coming in every quarter, teed up.
That's shovel ready.
That's shovel ready, that you don't want to build 50 houses at once, because once you close them all, what are you going to do? So you've got to kind of phase it out.
So are you contracting these properties but not closing on them until you want to close on them, or until approvals get put in place?
We try to have a 3 or 4 month due diligence, and then if we can, we'll try to entitle some of it. So one thing to explain, horizontal versus vertical. So like the entitlement, development, where you go and you take a raw piece of dirt, like we're not in that. Like that's a whole nother, very lucrative. That's a whole nother game.
But it is its own animal.
Own animal, and like financing. Good luck on that.
You can't.
Horizontal doesn't exist.
Well, where I've always gotten burned, I've done a couple speculative land plays before. That it was either raw land or it was zoned for something else. We wanted to turn it into multifamily.
Yeah.
Dude, it is a 1 to 2 year long process with hundreds of thousands of dollars. And I didn't want to wait that long, so we just took it down. And then guess what? Couldn't get it zoned.
Yeah.
Right? And now you're stuck with a piece of property that has different zoning than what your intended use was. And dude, you think you're going to make millions of dollars, and you don't. Right? Like, it's a horrible business model to buy land that's not already entitled and already zoned for what you want to do it, what your intended use is. So it's like the smart guys, what I learned is they'll contract the property and they'll close on it 30 days after the zoning is put in place, right? So the risk there is they're putting out a lot of money for a property that they don't own. Yeah. But and it's good for the seller, because if they don't end up closing, somebody else put up $200,000-$300,000 for the entitlements, and it improves the value of their land. And it's good for the buyer, because now they don't have to actually pay $1 million for the land and pay $300,000 for the bill or for the entitlement. And so that's a very that's typically the clean. I would never buy land again that wasn't entitled unless it was done that way.
Done that way, or that's your niche and you've done it before. Because there's a lot of people who make money in doing it, but well, not a lot of people. There's a very small percentage of people that can take it from start to finish and execute on that. But but you're right. A builder comes in and buys it on a takedown, to where you have 100 lots for me, and you're like, Chris, I'll sell them to you at 15 a clip. And so it's zoned, you've already developed it, and now you've got the end buyer, the builder. I come in and buy X amount per month or per quarter, And then I don't have to worry about finding it. I don't have to worry about doing the development. And mine's...
You put an option down on those?
Yeah. Yep, you can do...
So, hey, here's 10 grand or 50 grand
Yep,
or
seller
150
financing,
grand.
so we're working out a deal right now in Florida where, we're partnering with someone who's just going to go buy a bunch of dirt for us. And he's got us, and he can have his markup, and now that feeds our pipeline.
So that guy's going to go find the shovel-ready dirt,
Yep.
or get it entitled himself, take
Yep.
on that risk.
Yep.
And then he's going to sell it to the partnership at some agreed-upon value.
Mm-hmm.
And that agreed-upon value includes some profit share for him, and then he gets a little piece of the upside potentially in...
He could lend on it.
Yeah.
He could have hard money on it. He could have seller financing over 5 years. We'll cash him out sooner.
Or contribute it as an equity investment into your development project,
Yep.
and then get a
Yep.
percentage of the profits. So there's a lot of cool ways that you could structure that, and there's a lot of cool ways that you structure it on his side, and
Yep.
then he structures it.
He's got a guaranteed buyer. We've got a guaranteed acquisitions person.
There's
Now,
enough other
yeah.
risks out there where if you can limit those risks,
Yep.
and you know exactly what's happening there, you don't need to worry about. You can focus on the other risks that are a little bit more controllable as opposed to
And
those.
so another thing we're focusing on is diversifying our price point. Right now we're in the low 600s, mid 500s. Not super high, but high enough. I'd like to get into that 250, more affordable, where it's 1,000 square feet. You're building 8 to 10 at a time.
Yep.
Your margins will
those
be a
are
little
those
lower.
would be townhomes, though, right?
We actually have houses too. We have
Really?
3 twos down there, 1,100, 1,200 square feet. Absolutely.
Little bungalows kind of thing.
Yeah, little small homes that we can buy 8 or 10 on a street. A little bit lower margins, but a hell of a lot easier to try to get through 1,000 square feet versus 25.
I mean, the stuff that we're
3,000.
building is townhomes like
Yeah.
that. And so there's somewhere between 2 to 8 townhomes in a pad.
Yeah.
And we go in, they all look exactly the same. But we're building to
rent.
hold.
Yeah.
We're building to rent them out.
Just the Rankin project?
Yep.
Yeah.
And so we've been able to take these. I think we're into them for construction's probably $90,000 a door, but it's probably more with holding costs. But let's call it we're into it for like $120 a door.
Yeah.
But they rent for $1,500 a month
Yeah.
as a townhouse, and then and we're in the process of refinancing about half of it right now. We think, well, the lender has given us a valuation of $205 per door, and we're into it for $120, right? So like we're at below 60% LTV on these things.
That's
And
strong.
they're giving us a new loan. They cash flow positive. Like we're going to pay an 8% interest rate for a 5-year interest-only loan, but that's going to at least bridge the gap, right? Until
Get you out of that loan.
I want interest only because I already have plenty of equity. I don't need any additional principal pay down on it. It gives me 5 years, so runs it out. There's a prepayment penalty, yield maintenance and stuff, but I don't foresee rates changing that much in the next 3 years, anyways.
Yeah.
So I'm not too concerned about it. We'll let it cash flow. We'll let rents continue to increase. We'll make more and more of a spread on these things. But to your point, man, it's like, dude, they're like clockwork, cookie cutter.
Yeah.
Boom, 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 boom. And I love that product. I mean, what do you guys think you can build on price per square foot, those 1,000 square foot homes?
Probably low 100s.
Yeah.
Yeah.
So you're looking at
that's
about
the
$100 a foot.
Yep.
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 Which is amazing.
Yep.
I'd be interested in buying those from you, or contributing somehow to buy and rent those
Yeah.
communities.
Yeah.
Right? But for me, where I am, and I think this is a good segue, or I don't know, maybe ways we can work together, or I think a hack that I figured out when I bought this Rankin project is I bought we bought 165 units. 83 were already developed and rented, right? So there's no construction risk. There's no lease-up risk.
Yeah.
It's a stabilized asset. We paid a premium for it, but we've been able to put management and operational efficiencies in place in order to increase rents and create equity there. The other 82 units were shovel-ready, right? And we just had to go vertical on those and update some of the plans and prints and some of those things, and then we developed those. So there's construction risk, there's lease-up risk, but there's also more upside on these. And the price that we're into these for is 20% less than the stabilized ones.
Yeah.
But the stabilized ones and the cash flow from here offset the risk of the new construction.
Yeah.
The new construction and the upside from that offsets the marginal returns we would have had over here. So you're kind of taking two projects, creating a hybrid of the two, and then we raised money into a parent entity that owns both of those. So it was a cool way to offset the risk, still maintain equity upside, and have the best of both worlds, and kind of create a little bit more of a hybrid of stable project, new construction, marry them up into a single raise, a capital raise, and the investors ended up liking that, I think.
That's interesting. Yeah, I like that.
So it gives you a couple ideas on things to do. But if you got into that lower price point, I would all day buy developments from you, single family homes. Because I know what we're good at. What we're good at is the operational efficiencies on the property management and asset management side. The third party management, we haven't had any success with those. There's two management companies we like today, but we've had a lot of bad luck and bad interaction with third party management companies. So we've started bringing, we're about half the portfolio in-house now. And everything that my operations team touches, man, they do a fantastic job. It's just relying on third party management companies, relying on third party operating partners that aren't on a short leash, man, is where it's always bitten us in the butt. So
how many would you, what number makes sense for you to enter Jacksonville as a rental buy and hold owner? Like if we were to build and sell, let's just spitball here.
Yeah, I think $10 million of total product.
Okay.
All right, so if you had 50 of those single family houses and I'm buying them for $200,000, dude, I can size those up and then come in and I think at least 10 million gives me and the team enough intent and time to take flights down there, travel time, opportunity costs of other things. $10 million is enough where it gets our time and attention, knowing that hopefully there's a lot more beyond that. But I think an initial tranche would be, I'd be super interested in that.
50 homes is not impossible.
No.
Not at that level.
No, totally feasible, especially if, the rents and everything else makes sense. But I mean, we could talk offline on that.
Sure. Let's carve up the deal right now.
Well, I mean, that's why we do this, right? That's why we have these conversations. what can come from it, right? This is not something that we talked about offline prior to you and I sitting down. It's why we sit down and have a conversation with entrepreneurs about this kind of stuff of like, dude, how can we support each other? How can we? And this turned in from an opportunity to give value to people about new construction and some of the pitfalls that you've gone through and I've gone through, and all of a sudden could turn into a multi-million-dollar, decamillion-dollar type of a transaction where it builds long-term wealth for both of us.
It makes a lot of sense. If we've got an end buyer, like, man, the pressure's off.
Yeah.
I'm gonna worry about selling it, although not too concerned about selling a $200,000 house. That's a little bit easier. But man, to have you or someone in the background, hey, I'm ready when you're done, and then boom, now you got a machine, you got another model there that you're building. You got the, like you said, the hybrid. You got the sell, and you got that rent model too. I love it.
Yep. I think, and for me, realizing like this is what we're good at. We're not good at the new construction. We're not giving it full time and attention. I have to lean on a general contractor or a partner or something else to do that. We'll still do a little bit of it, I think, ourselves. But it's going to be no more than 2 projects at a time. Just for what we're good at and what we're. I would much rather. Buy a couple stable projects and then have one of these over here. Kind of like what I was talking about with the hybrid model, but maybe 2 stable, 1 new construction. And but if I can come in and I don't have the construction risk, I'm willing to take on the lease up risk because I know what the team's capable of. And so I would come in at vacancy and bring either operations at that time or bring money at that time or bring, and then close after or a hybrid or something. I think there's a lot of cool ways that you can structure it. But if you have hey, you stay in your lane, I stay in my lane, and all of a sudden 1 + 1 = 3. We're able to do way more together. I think is a powerful notion and something where people understand you don't have to be, a Renaissance man and do everything amazingly well. I think the more focused, the more niche that you are, the more money that you're going to end up making, and the less headaches you're going to have along the way too.
It's a team sport. We all have to come together to make our lives easier, and I would say to kind of recap that is for folks that are interested in new construction or looking to get in, it's going to take talent and money, really. It's going to take a partner. I can't even hang a picture frame. I don't care about that, right? But I have a partner who knows how to build houses, and he needs help with money. So if you can offer one of those, that's going to help you get in versus, I want to do it by myself. And the second thing I would say is, credit on its face isn't much. It's how you apply it. And so if I kind of doubled down on that skill set, and now I'm doing big development deals. I took a boring old topic like credit that nobody cares about, but I found a way to apply it and help ease the burden and make us money. And now I'm in bigger stuff. And so whether your skill set is, I don't know, acquisition, disposition, money, or whatever, double down on that.
Yep.
Find a way to really exponentially plug it in to a bigger deal, and that's where the grind is worth the wait. And that's kind of what, you know, I've been working on over the last year and a half. It was never like, oh, credit stinks, I can't make money. No, it was like, how do I use it better and more efficiently and in bigger stuff?
Well, I mean, I remember sitting down, you and me at Owlbear, I think it was, and you're like, hey man, should I lean deeper into this credit thing? And I was like, you're doing amazing with it. It's a skill set that will feed whatever you want to do next. And, you know, realizing you're not going to do the credit thing long term, but you are in some capacity, right? You're still doing it. It's just, it's a tool to do the next thing. And I love that you leaned in heavy on it because you developed, you know, you're known as a credit guy, right? You're known as a guy that people that you can help people gain access to money, that people want to lend money to, and because you have access to deals, and you're kind of like the bridge in between, you know, operations and
the banks.
Right? And so you're in between both of those, and you're able to help these people get into this deal, help these people get funding over here. You can take a little piece of the action in the middle. It's a great business model, man. So awesome, buddy.
Cool. Thanks for having me.
Exciting.
Appreciate it.
It's exciting everything you got going on, man. I'm excited to, you know, just continue watching the journey and continue seeing you continue to build and I mean both physically and metaphorically and theoretically speaking, your business and continue to grow the wealth and continue to make the impact that you're making, man. So appreciate you, brother.
Thanks for having us. Appreciate it.
Hey, hopefully you guys took some notes on that. There's a lot of great takeaways that Chris shared and a lot of wisdom, right? And a lot of things that, you know, we all wish we kind of would have known before we got into some of these things, but it's almost ignorance is bliss in some capacity because it would hinder a lot of people from moving forward and taking action if you knew that you'd be facing some of these difficulties. So it's more important to take action and then right the ship and make these course adjustments, right, as you move along than it is to have everything in line. And Chris still making great money on all these different deals and has continuously sharpened his axe moving forward on the next project, the next project, the next project. So guy's an absolute rock star. Make sure you're following him on social media. And I'd love to hear some of your takeaways in the comment section below. That's why we give as much value as we try to, so that way we can positively impact your life, your business, your finances, and your personal wealth. So give me a like on the video if you please would. Share it with somebody who would get some great value out of this and put some comments in the section. Until next time, see you on Spilled Beans.